thanks to the questions from previous students as they've taken the test and successfully passed, just said, I struggled a little bit with some of the concepts in the laws section. And one thing that popped up kind of consistently over and over and over was the difference between HOPA, HOEPA, higher priced, higher cost. And so we thought we'd take time to kind of explain the difference. So HOPA, okay, without the E in the middle, is the PMI Act, or the ability to drop mortgage insurance once you hit a certain LTV. A lot of people aren't having problems with that, so I'm not going to dwell on that. What I do want to dwell on is HOEPA. Notice how I'm pronouncing HOPA and HOEPA differently. HOEPA, because there's that E in the middle. So let's talk about the Homeownership and Equity Protection Act. So the law is to protect borrowers' hard-earned equity. It was enacted in 1994 as an amendment to TILA to address abusive practices and refis and closed-end home equity loans with high interest rate and high fees. So in that very, very simple sentence, you should understand HOEPA. So whether it's a Section 32 loan, whether it's a higher interest rate or higher fees, that's HOEPA. The Home Ownership and Equity Protection Act. It is a law. It is under TILA, and you may be tested on it. Okay, Section 32, higher cost. So now let's shift gears and talk about higher priced. So that's HPML, the higher price mortgage loan. A higher price mortgage loan is a mortgage where the person's dwelling has an APR, an interest rate that exceeds the average prime offered rate for a comparable transaction. So it's more expensive. It's higher priced. Do not think that high cost and high priced are the same. They are not. That's why I'm trying to give you this line of delineation between higher cost and higher priced. Okay, high cost, Section 32. Higher priced, Section 35 of TILA. So yes, higher price is also a subsection of TILA, but I wanted to differentiate the two. Now, depending on feedback, I may have to make it even more clear in the future. So I want to move on. We talk about RESPA, TILA, HOPA, HMDA, FACRA, code. You see how absolutely easy it rolls off my tongue. But for you guys, it's different. Is it Reg X? Is it Reg Z? Is it Reg B? Is it Reg, N? Is it, what is it? So for purposes of the exam, you should be aware that they may not come at you at a question with RESPA. They may ask you a question according to Reg B, and you need to know the laws and the regs that well that you can just pull it out of your head. Never mind the law, the Equal Credit Opportunity Act, never mind the acronym ECOA, you have to know that it's Reg B, and HMDA, Reg C, and MAP, Reg N. You just have to know these things if you're going to successfully pass this exam on your first attempt. Now, most of the questions that you're going to see on the test are situational, meaning what is the proper application of the law in the circumstance that they ask you the question. So it isn't just a regurgitation of memorized information. Don't memorize our sample questions. What is it that we're trying to teach you? Then take that knowledge and convert it into wisdom, the application of knowledge, meaning, okay, I know in TILA, I'm supposed to disclose an APR. So RESPA is a little bit more of the breakdown of costs. TILA is a little bit more of what does it mean dollar-wise, interest-wise to you, okay? And so if you can start to separate these laws, if the laws are kind of, okay, I understand that RESPA and TILA are a disclosure law, and HMDA and fair housing and ECOA are more discriminatory laws. If you can start to differentiate in your mind the differences of why we have these laws, I think you're going to do better. And then how do you apply this? So a little later, we'll talk about like redlining and reverse redlining and things like that. How do you, in the particular way the question is phrased to you, how do you apply it? Okay. Now, there was also some questions on QM. So let's take some time on QM. QM means qualified mortgage. All right, a little bit of history so that you understand where we came from to how we got to here. In the past, and I'm talking about, early 2000s, okay? So before 2010, early 2000s, the industry was very, very loose in underwriting guidelines. It was very non-traditional. It was very subprime. It was very unregulated, okay? So then we had that mortgage crash, the Great Recession. I mean, we had all of that really, really bad history in our country, 2008, 2009, 2010, et cetera, et cetera. Okay. Since that time, we're looking back saying we don't want to go through that process again. So then you have lenders that are saying, well, wait a minute. If we do a loan, how do we know we're not going to get sued in the future by either the government making us buy back loans, by the agencies making us buy back loans, by borrowers taking us to court and us looking like we're the bad guys? Because if you remember those lenders got spanked. I mean, millions and millions and millions of dollars in fines and penalties. And so up came a standard. A standard was created which was called QM, a qualified mortgage. Lenders, if you do a QM, you're bulletproof. You cannot be sued. Anybody can be sued. You can be sued, but whoever it is that's suing you won't win. And so industry was like, okay. What are the guidelines? And I think I could put the guidelines on one hand. So a QM basically has 4 to 5 components. But it basically has 4 or 5 components. Number 1, term. A QM or a qualified mortgage does not go longer than 30 years. So if there's a 40, 50, 60-year mortgage out there, it's not QM. Number 2, it doesn't have any risky features. What do I mean by risky feature? A risky feature is like a prepayment penalty. A risky feature is like negative amortization. A risky feature is interest-only payments. So it does not have any risky features. Number 3, that you take into account ratios. On ratios for purposes of the exam and for purposes of QM, not real life. We're looking at a DTI, a back-end total debt-to-income ratio of 43%. Now, depending on when you jumped into the industry or when you re-jump in, or what GSEs are doing at 45 or whatever, right? Don't do an internet search. Stick with what we're telling you because we're trying to help you pass what is on the test, okay? I'm not saying it's reality. I'm just saying it's what's on the test. At 43% DTI, we've taken into account the 7 things included in a house payment, anything that's on a credit report, anything that the consumer has a monthly payment on. Now, I know there's some things that they have a monthly payment on, like Netflix or Hulu or Disney Plus or whatever. Okay, they have utilities, they have insurance. I get that. But it's basically what's on a credit report, what's been court ordered, what the borrower has that, reoccurring payment on that is counted toward a DTI. If it exceeds 43%, it is probably not a QM. Are there non-QM products out there? Yes, but you do not have enough experience when you do your internet search to know the difference between non-QM and QM. Please be very, very careful. Okay, it's not that I'm not prohibiting you from checking on anything that I'm telling you. You may not know the differentiation of what the heck you're looking at. And so please, again, be careful. Fees, costs, and points. It's a QM loan if fees, costs, and points on a $100,000 loan or more are 3% or less. Now, I just shared a lot of information with you in not a whole lot of words. Well, Dave, I heard that you can go up to I've asked you over and over, be careful what you find online, because could it be 5% in fees, costs, and points? It could, but you're not going to see it on the test. Is this part of CFPB? Yes. Is it on the CFPB's website? Absolutely, but it pertains to loan amounts. The smaller loan amounts to incentivize or to even cover costs, right, to do those for lenders, they're going to need to charge more money. But if it's a bigger loan amount, they don't have to charge as much. And so there's a cap or a limit of 3%. So could you find things higher than 3? Yes. Ignore them. Do not pay attention to them. You won't be tested on them. And the last thing is, how do we determine that 43% DTI? So first of all, we document and verify the income. You have to document and verify the income and that the borrower has ATR, the ability to repay. So on that documented income, what interest rate are you using to get to a 43% DTI? So you could possibly be using a fixed interest rate. So you have the income, you have the debts, and then your final or back-end DTI is 43% or less. But the question is, what happens if you have an ARM, an adjustable rate mortgage, where the interest rate would obviously adjust, change? Then what you're going to use is the highest rate that ARM, the adjustable rate mortgage, the index and the margin, the highest that could go to in the first 5 years to qualify the borrower. And if it's at 43% or less, you have a QM. Got it? Cool. Hopefully you were making notes on that one. So those are the things that make a QM loan. Possible questions on the exam could be any one of those things that I just gave you. Also, I talked about things that are not QM. Industry calls it non-QM, and you need to know the difference. In fact, you also need to know the difference between other terms that we use in the industry. For example, everything that I've been talking about, most of the time, is a forward mortgage, meaning the loan is made today, then the borrower, going forward is making payments to repay back that loan. There are other names for other loans that are out there. Please don't confuse them.